Hello, it's Peter here again from ouncegold.com, where you can find easy tips to help you begin your investment journey through gold, silver and precious metal investments. If you haven't done so, don't forget to subscribe and hit the bell icon to be updated whenever we release another video. And coming up today, 10 investment terms you should know. Beginning something new is always difficult, and being a new investor is no different. That's why we've compiled a list of investment terms to help you along the way at our website ouncegold.com. You'll find the link in the description below. There are literally hundreds of terms, phrases and jargon that are just downright confusing. You don't need to memorize all of these terms straight away. However, I suggest maybe bookmarking the article page on ouncegold.com and using it as a guide whenever you find a new investment related phrase that you don't know the meaning of. In the meantime, for those of you who want a leisurely explanation, we've also decided to come up with a series of videos, each concentrating on around 10 of the most popular investment terms. And so here is investment term number 1. What is ask? Ask in investment is described as the lowest price the seller of a share or security is willing to accept. It's also known in investment circles as the offer price. Normally, when advertising the ask, the amount of shares available are also displayed so that the interested buyer will be informed. It's important to note that buyers only accept an ask price when it is at its lowest. Nobody wants an ask price that is quite high. Here is an example. If an ask price is displayed in the stock market as $2.51 times 500, this means that an investor is willing to sell 500 shares at $2.51 per share. Next, what is active investor? Active investors are those investors that engage in active investing. Active investing is a type of investment in which the investor is continuously buying and selling shares. This type of investors keep on monitoring the activity of the market and take the opportunity of the rise and fall of the stock markets. Active investors do not involve themselves in long-term investing. They do mainly short-term investments and get their profits immediately. This type of investing has several benefits, like it helps to minimize the risk of investment and also ensures that profits are gotten immediately. Its limitations, however, is that it involves lots of money as you are constantly buying and selling, so the investor needs to always have money at hand. And next, what is asset allocation? Asset allocation is another type of investment strategy. The purpose of asset allocation is to try to create a balance between risk and reward. There are basically 3 classes of assets, and they are equities, fixed income and cash or equivalents. All of these assets have their different risks and rewards, so asset allocation puts the goals and investment expectations of the investor into consideration before choosing any of these assets to allocate funds to. Asset allocation is individualistic in nature, and it varies from one investor to the other. There's no formula that can be used to determine the best asset to allocate funds to for a specific investor. However, making the decision of which asset to allocate funds to is very important, so it's not something that is done in a hurry. And next, what is after-hours trading? As the name implies, after-hours trading is best described as when an investor buys and sells shares and securities after the market has closed, i.e. after the regular trading time. Normally, the trading time in the stock market is between 9:30 a.m. to 4 p.m. Eastern Time. After this time, it is believed that trading should have stopped, but after hours trading still takes place between 4 p.m. to 8 p.m. Eastern Time. This form of trading has its attendant risks and benefits, but for some investors it has proven to bring in more gains for them. And next, annuities. Annuities are financial products that have the ability to give an individual or fixed continuous flow of income. This type of income stream is usually used by retired people. Annuities are created by big financial organisations and they are sold to individuals. The funds gotten from the sale are now invested, then calculations are made and those who bought the annuities are paid a fixed continuous income. As you can see, annuities can be said to be a reliable way of having steady cash flow in the life of the investor. This helps to make sure that the investor does not lack money. And number 6, what is a balance sheet? The balance sheet is a document that gives a report of all the assets, liability and shareholders' equity of a company at a particular time. This report helps the company to calculate profit and also evaluate how it spends money. It's a summary that shows the company what it owns in assets and others and what it owes to people, and also it gives them an idea of how much their shareholders have invested. The balance sheet has an equation and it's here. This helps to calculate the assets of the company, among other things. This equation shows that for a company to part from its asset, it must get funds from either liabilities like loans and from shareholders' equity. And next, what is bear? A bear is simply a type of investor who is convinced that a specific security is diminishing in worth and tries to make profit from the fall in stock prices. This means that bears are always negative or pessimistic when studying a given security. They want the prices of securities to reduce, which will give them opportunity to make profits. The bear mentality can be used in different types of markets, like the commodity market and the stock market. And next, what is bull? This is another important term in investing, and this is opposite to bear. A bull can be described as an investor who believes that the market or a particular security is going to rise. This means that the investor buys the security at a low price and then hopes to sell it at a higher price sometime later. This type of investors are optimistic, unlike the bear investors who are pessimistic. Being a bullish investor is not an easy task, as you'll need to study to pick out the security that will increase and not fall. So what is a bull market? A bull market can be defined as a market that consists of a set of securities whose prices are rising or are tipped to rise. This term is used mainly in the stock market, but it can be used in many other financial spheres to define the same phenomenon. This market is one that is characterized by optimism, as the investors believe strongly that the price of the securities will keep rising. As you know, it is not easy to define trends in the stock market. It takes experience and a bit of heart to predict the stock market and invest your money in it. Now, what is a bear market? This is a direct opposite of the bull market. This market is characterized by pessimism because the prices of the securities involved in this kind of market are falling. It's important to note that any security can be in either the bull or the bear market. It all depends on the security, on whether it's falling or rising at that time. So, in making investments, some investors also gain from this type of market, even with the fall in prices. So there you have it, 10 investment terms you'll need to know. Watch out for more investment term videos coming up soon, as well as our other videos to help you make the most of your investment journey through gold, silver and other precious metals. You can read the full article in the links in the description or by going to ouncegold.com, where you can find more information in how to start investing in gold and other precious metals. Now don't forget, you can also follow us on Twitter and Google+, and don't forget to click the subscribe button and hit that bell icon so you can keep up to date when we upload another video. My name's Peter, and see you next time. Bye for now.